Hello, welcome back. A lot has happened over the last few days, over the last week. We have the second biggest bank bust. We have a backstop as a bailout on Bloomberg already announced here. And of course, on the background of all of that, we have expectations for the Fed rate hike dropping. As you see, just at the end of last week, the market was expecting that the Fed might raise by 50 basis points, with a probability of around 40%, and the remaining 60% of probability was expecting only a 25 basis point hike. Today, the expectations have changed quite a lot, with only 55% probability for a quarter point hike and a 45% probability for no rate hikes at all. That is, of course, with the expectation that with all of those several banks going bust, the Fed will not be able to rate hikes anymore. And beyond the next rate hike, an interesting chart has been posted by Zero Hedge. These are the expectations for Fed rates going all the way into early 2024. Just a few days ago, the expectations were for the Fed rates to rise all the way into the second half of this year and then gradually decline to still stay above 3% by early 2024. In just a few days, as you see, from the 8th to the 9th to the 10th of March, the expectations of the Fed rates have dropped quite a lot into the end of this year. And yesterday, the expectations are already down into negative 2.5%, meaning that by the end of this year, the market is already expecting Fed to cut rates rather substantially. All of this, of course, will have its implications on the price of gold as well as the strength of the US dollar. So let's have a look at the dollar first. I still think that dollar finished its intermediate cycle at the beginning of February, and it's now coming down with this expectation of more dovish Fed, and we have just over a week until the FOMC meeting. So into that meeting, if dollar does continue down, that will bring this daily cycle to 49 days, pretty close to an average duration of a couple of weeks. So perhaps this trend will continue, and if the Fed is simply not as dovish as expected, that might actually push the dollar into this second daily cycle of the ongoing intermediate cycle, where the dollar might perhaps test the 200-day moving average before generally declining down into the daily as well as the intermediate cycle low sometime later. That's not as interesting. That's a little bit further into the future. Looking at gold right now, that's what more interesting. Gold has gained quite a lot with this expectation of a smaller hike or perhaps even a no hike. And the main question on gold here is whether this late February low was the intermediate cycle or still only a daily cycle low. What I mean here is that if that intermediate cycle low in gold has finished, then gold will generally trend upwards for perhaps another several months. But I would give this perhaps a 45% chance, so that's quite likely, although perhaps slightly less likely than a 50-50 coin flip. Yes, RSI came pretty close to oversold over here in late February. That might actually be enough for an intermediate cycle low. Over the last couple of years since the pandemic, we have seen one of these intermediate cycle lows with the RSI coming close to the oversold level, but not dipping into that. So it is a possibility, again, perhaps a 45% chance if the Fed is somewhat dovish, but there is still a pretty good chance, perhaps a 55% chance, that this intermediate cycle that started over here at the end of September is still ongoing, meaning that we haven't seen the intermediate cycle low yet. So we have the first daily cycle, second very long daily cycle, and we're now in the third daily cycle, which will still give us another buying opportunity before the new intermediate cycle in gold takes place. But the certainty on this scenario is not extremely high. Again, perhaps only around 55% chance. After all, silver isn't really confirming much of a new intermediate cycle yet. Over here in late September, silver was performing pretty well. New highs versus mid-September as well as versus August. Right now, there are no new highs on silver, and silver hasn't really broken above the 50-day moving average yet. There's still quite a bit of distance to go above that 50 DMA. GDX hasn't broken above the 50 DMA either, as it did over here at the beginning of the previous intermediate cycle. And looking at the optimism index in gold, it did drop recently all the way down to around 38. It might be close enough for that intermediate cycle low, hence a 45% chance for that scenario. But the decline from high 50s to high 30s of only around 20 points, yes, it could be enough for an intermediate cycle low, as it did happen, for example, in late 2021 over here. But it's more common to see a slightly larger decline on the optimism index down into the intermediate cycle low. Hence, again, still a pretty good chance of one more move down in gold. But a lot will also depend on CPI announcement this morning, just before the markets open in the US. The expectations so far are for around 6% CPI. The previous reading was around 6.4% year-over-year CPI. What I think is perhaps CPI is going to come at slightly below 6%, maybe around 5.8%. So perhaps at the beginning, some markets participants might take it very enthusiastically, expecting the Fed not to be very hawkish. After all, CPI is falling, plus we have all of these bank bailouts. But on a second look, perhaps other market participants will realize that while CPI might be declining, it's still far from Fed's 2% target. So while the Fed might be printing money to bail out those banks, they might still at the same time raise rates, creating a lot of volatility perhaps today, this Tuesday, on the markets. So a bit of a possibility here is quite a lot of volatility today. The daily cycle is 15 days long, perhaps a general continuation higher as markets expect a relatively dovish Fed into that 22nd of March. And maybe a bit of a double top over here as we drop down into the intermediate cycle low. Perhaps sometime in April, closer to the average duration of these daily cycles, which last anywhere around 1.5 to 2 months. Of course, they can be shorter and can stretch sometimes. And closer to the average duration of these intermediate cycles. Although this intermediate cycle in that case might turn out to be rather long, at around 200 days long. Hence that 45% chance probability that we have already seen the intermediate cycle low at the end of February, with the intermediate cycle lasting for 152 days, pretty close to an average duration of half a year. And in that case, gold will generally continue higher, with of course some corrections down into a short-term daily cycle low. And while we're talking about this second 45% chance scenario, let's have a look at this seasonality. All the way from 2015, the end of that previous bear market in gold, we see that seasonality generally agrees with this 45% chance scenario, a bit of a dip into March, with a general uptrend for about a month after that. So gold is somewhat tricky. What I mean by that is it's pretty close to that 50-50 flip of a coin, but again, I'm leaning slightly more towards one more dip in gold, perhaps just after the FOMC, if the Fed isn't as dovish as the market wants them to be. But perhaps gold might not even break to significant new lows with that one more dip down. Now, next, looking at the general stock market, S&P 500 in front of us. As I mentioned to the members at myfinancesteacher.org, that was just a few days ago. This level, 38.90 to around 39.40, is somewhat important. We have the 200-day moving average in that area, and this level has been respected by local highs and lows several times over the last year or so. We've lost that level, and I've been expecting a general downtrend in the markets down into the intermediate cycle low, assuming we are in a new daily cycle since the beginning of March, which perhaps is still questionable. As I mentioned in my recent YouTube video on these gold and stock markets, it's not very common for a daily cycle to top just 3 days into this cycle and continue trending generally down from that. So here's how I see the general stock market right now. Basically, there are a couple of scenarios. One scenario is that this daily cycle has truly started over here at the beginning of March, and we're going to see a couple of days upward momentum as the market is perhaps expecting Fed to be somewhat dovish, especially if the CPI this morning is going to come noticeably below the expectations of 6% year over year. So perhaps a test of this 200-day moving average coming close to the FOMC, but if the Fed not as nearly dovish as required, as expected by the markets, we might see a continuation down into this daily cycle as well as intermediate cycle low. And I would give this scenario again perhaps a 55% chance. I still think we probably have seen the daily cycle start over here in early March. So as we broke below the 50-day moving average, expecting this decline down into the daily cycle low, I was pondering shorting the markets. Unfortunately, I didn't do that until we broke below the 200-day moving average. That was rather late, and I kind of stopped out yesterday. Depending on how the market performs, of course, today with the CPI and over the next few days, I might have another go, we'll see, but it's important to manage your risk with those stop losses. As the second scenario, let's change the color over here, is such that the daily cycle that started over here at the end of December has actually continued all the way down into mid-March. And perhaps we are in a new daily cycle. If CPI today is relatively low, if the Fed is not really hawkish at all, that might actually push markets significantly higher, perhaps a poke above the 50-day moving average before the drop down into that intermediate cycle low. After all, looking at this market optimism index, all the way since the beginning of this bear market, that's since mid last year, every intermediate cycle low came with this optimism index touching this green line and dipping below that. We haven't done that yet. Usually you would expect that in bear markets. Yes, of course, it doesn't have to happen in bull markets, as over here, for example, at the end of 2020, we've seen an intermediate cycle low with this optimism index only dropping to mid-50s, but we are still perhaps in times of turmoil, again, with a lot of uncertainty in the banking sector right now. So even if we see a bit of a bounce over here, maybe even a bounce into a new daily cycle low, there's still a pretty good chance that we might see this optimism index, maybe after a bit of a bounce, touch that green line, giving us an intermediate cycle low and that next buying opportunity on the long side. And looking at a shorter term optimism index with this 10-day moving average, this green solid line that we also mentioned in one of the recent videos, it has dropped below 30, which usually indicates a daily cycle low, but it hasn't bounced yet. Again, suggesting that there is still a pretty good chance for the second 45% chance scenario. The daily cycle that started over here in late December has been ongoing even with this bit of a bounce over here in early March. So all in all, exciting times in all of the markets. Things are getting pretty interesting out there. I'm also interested in what do you think about all of these banking bailouts? Let me know down in the comments below, and make sure to hit that like button and share this video with your friends. Have a nice day. Bye bye.